All right. New week, new highlight. This one just happened. Dave, would you mind scrolling down this top chart real quick? When a market, thank you. When the market moves fast, you have to think it's going to be respected. So you get the market to move fast like that. It moves fast again like that right here. Okay. What's the difference? In here, they should respect it, which means come up a little bit and then move lower. They did something that was different. They almost retrace 100% of the move. So the move is lower pretty quick and they retrace all of it. And I had said at that moment, that's kind of bullish when you think about they can't even hold half of the sell-off. And then all of a sudden, wham, it comes in fast. Before it gets down here or even here or here, was right in there. I said they took back something that was kind of bullish at the snap of a finger. This thing has some real good downside, and it's going to get to these 50 evens, which has been a target or a magnet for a while, and I'll show you why it was a magnet for a while in a second. So it's not just a move that happens fast to the downside or upside, in this case, downside. It's what happened before it. All right. So if you've got a move that goes down fast, and right before it, it was kind of a bullish transition up, you probably have people laying bids in the market to open long positions. Every move lower doesn't have people buying it, necessarily opening up long positions, sometimes more or less. But when you have a lot of people that are buying it, for instance, in this particular chart pattern, if all these yellow lines are people opening up long positions because they seen something that was bullish, that's going to exaggerate the downside. That's when saying in here, there's some really good downside left on this, doesn't feel like a good guess when you're right. So on any move down, is there something that could show or tell you that there was a lot of people opening up long positions? And why is that significant? If a lot of people are opening up long positions and the first thing that happens to them is heat, they're underwater almost as soon as their position opens. That generally has a lot more downside attached to it. Now, Dave, you could pull up this chart and show the iceberg at 50. This solid gold yellow line is an iceberg, which he's showing, I think, 75 contracts, but he's done like 250 so far. And we could see that down in here once you see it come about. That's generally a magnet. It's generally someone who's got more to buy than meets the eye. And a lot of people think, well, the market should rally when someone's got more to buy than meets the eye. That's conventional wisdom. A lot of people, when they get a feeling there's a lot of buying, they buy it, they become long, they become too long, they become sellers that send it back down for the same reason they got long. This guy will get taken out, and we'll see how many he did and what kind of reaction was around this price of 50 even. And so even though it wasn't necessarily super easy, the right side was the downside as this market tried to get away from 50, couldn't really, and had some really good moves back down to take them out. It never goes from 15 points higher right down and takes a particular level out. It has to do this. It has to dance around and then jump through it. And so if you watch the market on September 8th, Tuesday, September 8th, at around 10:30 Central, 10:35, 10:40 Central. Take a look to see when it takes out 50 even. Stay safe and subscribe.